Hi, everyone, and welcome to the Real Vision Daily Briefing. I'm Andreas Steno Larsen from Real Vision, sending to you live Thursday, September 15th, after a tricky week in markets on the back of this shocking inflation report earlier this week. So today we're going to ask the question, why are equities holding up so well given this list of negatives surrounding the outlook for the economy? And with me today to debate that question, I've invited Eric Johnston, the head of equity derivatives at Cantor Fitzgerald. Eric, it's really good to see you again.
Andreas, great to see you. Glad I can be here.
So, Eric, first things first, this question that we're asking today, why are equities holding up so well? We're still a pretty decent distance from the lows seen earlier this early summer. What's your take on that question?
So it's a great one. I've been very surprised myself that we've held up this well. So here's what I think is going on. So far during this sell-off, institutions have brought down their exposure in a pretty significant way. So if you look at CTAs, they're net short equities. They've sold a fair amount this year. If you look at mutual funds, they've raised their cash levels in their equity portfolios to some of the highest levels in a long time, possibly ever. They're at about 6.1%. And then hedge funds have brought down their gross exposure and have brought down their net exposure to, they're essentially in the 1 to 5th percentile over the last 10 years. But on the other side of that is the individual investor. And as you remember, during the run-up post-COVID, the individual investor put somewhere around $1.5 to $2 trillion into the equity markets. And what's happened during this sell-off is that essentially none of that has come out yet. Okay, so the individual investor has not been selling equities. It shows up in the data, and I'm sure everyone watching this, people they talk to, family members, people have not sold. And so I think the next leg of this sell-off is going to come from those outflows from funds and the individual investor essentially reducing their exposure. If you look at the individual investor's allocation to equities, it's close to historic highs, somewhere north of 60%. So there is plenty of room for them to reduce their exposure, and I think they ultimately will. But so far they've been very stubborn. And if you think about the amount that they added on the way up, if they were to sell 1/3, a half of what they bought post-COVID, that would be enough to move the market sharply lower.
That's a really interesting point, Eric. There is a big divergence between the positioning among institutions and the positioning among individuals. But if you're looking for sort of triggers for a sell-off among the individual investors, what could be the triggers that you're looking for?
So I think there's a couple of things. So one of them is the alternative to equities. So we've had yield suppression now for essentially 12, 13 years, where the individual out there has been looking at an alternative to equities that's yielding anywhere from 0 to a couple percent over the last 12, 13 years. And the recent move that we've seen in interest rates has been parabolic, right? And it's happened, and we can talk more about this related to the markets, but it's happened in a very short period of time. And so we're going to look up in 3 or 4 months, and money market funds are going to be yielding 4%. If someone said we were going to see a 4% money market yield a year ago, people would have thought you're crazy. And so that takes time for people to acknowledge that rates are higher and that they're going to be higher for longer, and they can actually get some yield. So I think what will be the catalyst for people selling equities and moving some into money market funds is going to be people, number one, sort of understanding and seeing these yields in very short-term paper. And then number two is I think losses. I think that as some of the larger cap names, come into play, where they might, miss on earnings or what have you, that lower prices, I think, and negative momentum is what's going to cause the selling, because the individual investor has seen over the last 12 years, every dip is bought, just be patient, stocks will go higher. And at some point, as this sell-off continues and as it drags on, I think that patience will go down. The one other important point I would say is that if you look at some of the data that I think is really important, in the second quarter, there was about $300 billion that came out of deposits from checking accounts at banks. And in addition to that, you've seen credit usage surge over the last 6 months. And so what that tells you is that the consumer are starting to dip into different pockets. They're dipping into their deposits at checking accounts. They're increasing their balances on their credit card. The next thing that could come is I need to withdraw some money from my stock account to fund my lifestyle with this 10% inflation environment.
If we look at a comparison between equities and interest rates on short papers, one of the ways that you can do that is via the earnings yield on equities relative to the interest gained on, for example, short-term treasuries. If you look at that ratio between the earnings yield in equity space and the yield on papers, what's your take on sort of the ratio between the two in a historical context?
So if you look over the last 12 years since the financial crisis and this new regime that we've been in, the equity risk premium, essentially the inverse of the PE, so the earnings yield minus the 10-year yield. If you look at that ratio, that index, what you'll see is that it's showing that the equity risk premium is actually at a 12-year low. So at a time when I think we would all agree that the risks around equities are extremely high right now, right? We have a Fed that's doing an experiment here that we've never seen before, going from the most accommodative Fed policy ever to the most restrictive Fed policy in the last 20 years. And it's all happening in a year. So the risks, including quantitative tightening, et cetera. So the risks right now are extremely high, yet the equity risk premium is at a 12-year low. So to me, that is going to correct itself. To the first question you asked, I'm surprised it hasn't so far, but feel confident that it will.
Eric, if we look at sort of implied levels, for example, in the S&P 500, that would allow the implied earnings yield on equities to sort of rise to levels that could accommodate new buying of equities. How low do we need to go in the S&P 500 to really accommodate new buying when we look at it from an earnings yield perspective?
So right now, the equity risk premium is at about 2.4%, looking on forward earnings, and assuming the estimates are correct that we see in print, which I don't think they are, but let's assume that they are. And so in 9 of the last 11 years, the equity risk premium has hit 4%, has gone up to at least 4% in 9 of the last 11 years. And so if you were to get to a 4% equity risk premium, you would be talking about a S&P in the low 3,000s. And if the earnings are not accurate, then you could be talking about lower. If earnings estimates are too high, which I think they are, but earnings have certainly proved resilient, thus far.
Let's talk about earnings, because I know you have a really interesting point in terms of earnings relative to inflation in highly inflationary environments. And you have a couple of charts that you can put up on the screen in relation to that exact point back from the 70s and the early 80s. What do you make of earnings in this highly inflationary environment right now?
Yeah, so I think it's when people talk about that inflation has peaked and that it's going to come down, that's something that I agree with, and I think is going to happen. I think it's going to be much more stubborn than people think, and I also think it's gonna come down, not because of natural forces, but because of what the Fed is doing currently. And so, when you look at earnings were helped by inflation. Earnings were helped by the supply chain issues that everyone was talking about. And so when people say inflation is going to come down, it seems like that's only the conversation goes to, and hence the Fed can stop at 4 or 4.5%. But the part that's missing in that is that corporate earnings, just like they benefited from inflation on the upside, they are going to get hurt when inflation comes down. So we looked at all of the times in history in the last 60, 70 years when we've had these big spikes in inflation. We took a snapshot of the point where inflation peaked over the course of the next 1 to 2 years, and what happened to earnings as inflation numbers came down. And that's the chart that you see on your screen. And that's a snapshot of all those different times. And what you'll see is in each of those cases, earnings came down. And the question is, why would that happen? Well, wages, employment costs are a very high percent of one's operating expenses. Those also tend to be much stickier and tend to lag the pricing of your goods and services. And so on the way up, that lag helped. And then you can think about it in an environment where demand starts to degrade, which is what the Fed is attempting to force to happen, then the price of your goods can come down a lot more sharply than your employment costs. So it's very easy to raise someone's wage. It's very difficult to cut someone's wage. And then as far as cutting the number of people that work for you, there's been a mismatch in the labor force. And so companies can be much more hesitant to cut labor. And so this is what's going to cause, in our view, some margin contraction and ultimately an earnings hit.
Speaking to this point of sticky inflation via wages, it's obviously fairly easy to get inflation from 10% year over year to say 6%, or at least manageable, but it's probably trickier to get inflation from say 6% back to 2%, the ultimate target for the Federal Reserve. So speaking to this point of sticky inflation, do you think the Fed will actually try and bring equity prices down to get the next leg lower in inflation done?
I do. I mean, I think that inflation now, people talk about the word entrenched. It's been going on for, somewhere high inflation for somewhere around a year and a half. And there's no end, in sight. So it is becoming entrenched. It is broadening out, right? Initially, it was supply chain. It was oil. Oil's now back to the high 80s. Supply chain has, mostly rectified itself, and yet we still have an inflation issue, putting up a 0.6% month over month core number, or 7.2% a year and a half later. So it is becoming entrenched. And so in order to get inflation down, it doesn't magically come down on its own when it's this high for this long. So if you have an unemployment rate at 3.8%, an S&P at 3,900, 4,000, that's just not, and you have a soft landing, that's just not going to get inflation down. You have to get asset prices lower. You have to get wealth lower, unemployment up. And as people have fewer assets, less wage growth, and more people are unemployed, then demand to pay those prices goes down, and the supply of goods becomes more competitive. And that's how there will be a shakeup in the economy to get prices to move lower and stay lower, which is the key. And so the Fed has a lot of work to do because we entered this with the economy in very strong shape, the labor force, supply and demand completely out of balance. So that's going to take time. We saw today the settlement with the labor union related to rails, a 24% increase in wages. It's still going on. Today, the Boeing CEO said we're going to have inflation with us for the next 5 years. And so the whole idea is that it's going to be much more challenging to get it down to the 2% area than I think the market is giving credit for.
A piece of anecdotal evidence in relation to this debate, Eric, from my side, I think we can bring up the tweet of the day in relation to that. I'm personally seeing more and more signs that inflation is also becoming sort of self-fulfilling in Europe. I'm contracting within private equity in the real estate sector in Europe. And right now we see rental growth as a lagged consequence of the increasing prices in right about every corner of the economy. And the housing cost is one of the lagging components in the CPI index. We also saw that in this week's CPI report in the US with a month-on-month increase in the shelter cost of, just south of 0.8%. Month on month, so that's basically a crazy number if you analyze it. But that leads me to the housing market, Eric, because I mean we've been talking about it for quite a while. We've had another terrible monthly print out of the Canadian housing market today, but I still think that we sort of lack the final evidence that the U.S. housing market is rolling over. What's your assessment of the housing market right now?
So I think it's similar to the labor market. There was a mismatch post-COVID, a shift going on in how people live their lives, remote work, and everything that we know that changed post-COVID. So there was a imbalance, but the imbalance I think is quickly coming into balance, and there will be I think prices will begin to move lower. The sharp rise in mortgage rates, clearly a headwind. The wealth effect outside of one's home is clearly getting hit based on bonds and stocks getting hit simultaneously. And I think also there is going to be a slow back to work and back to the office and less lenient policy. I'm not saying, we're going anywhere close to what it was pre-COVID, but we're more and more, I think that's the direction we're going. And the opposite was what helped the housing market to begin with. So, I think for all those factors, we are at the beginning of the weakening of the housing market. I think it's going on as we speak. And we know that housing is a slower moving asset price than equities, but I think it will head in a lower direction.
I wanted to play a soundbite for you as well, Eric, today, and it's from a debate between Ash Bennington and Jason Trennert on this higher for longer inflation narrative. So let's listen to this soundbite and get back to the discussion on inflation and housing.
So, Jason, what are those structural issues that you guys see in terms of keeping inflation higher for longer, and how significant a threat do you think those structural issues are?
Well, I would say, Ash, I think they're a threat. I don't think they're insurmountable threats, but they are things that are likely to keep inflation readings higher for longer than people perhaps are expecting. There's three in particular that I would focus on. The first would be wages. And as you may know, there are about twice as many job openings as there are people that are actively looking for work that don't have a job. And so particularly on the, I would say, entry-level service-oriented jobs, there's a lot of pressure on wages because there's really only one way to solve that equation, and that's through increasing the price of labor. So to me, that's structural. Secondly, I think the housing market, while it's weakening a bit, if you can believe it, house prices in the U.S. are up close to 20% year over year. That's very significant because housing prices tend to lead rents And homeowners equivalent rent is a very big part of the CPI, about 25% of the CPI. And so right now, I think there's going to continue to be upward pressure on rents. And then the third issue that's structural, it seems to me, and I don't want to offend anyone's politics here, but I do think that the West's environmental policies are keeping a price of fossil fuels higher longer than they ought to be, given the fact that we have a war and there are other geopolitical considerations at play. But that's a decision that the West politicians have made. I think it's a very risky one politically, personally. But those three things are not easily fixed, and I think are going to keep inflation a little bit higher longer than people think.
The entire interview with Jason Trennert is already available at the Real Vision platform for subscribers today. Back to you, Eric. If we take Jason's words for granted that we will be faced with an inflation pressure higher than what we've been used to over the past couple of decades for a prolonged period now, is there any way to sort of position for that in equity space outside of being outright short on index levels?
Yes. So I think one interesting sector that has clearly done very well so far this year is energy. But I think it is something that is going to continue for a few different reasons. So the first is that we're going to have a situation where the supply dynamic is going to change over the next month and a half with the SPR release coming to an end. And simultaneous with that, we are going to likely sometime within the next 6 months, you're probably going to see an easing of the zero COVID policy out of China, which is going to, sharply increase the demand from their perspective. In concert with that, you have less capital spending that's going on, and that's part of this overall inflation for longer story, is that as ESG becomes much more relevant by the day, and the decarbonization spending and views move forward, then you're going to have less capital spending on drilling, and so you have that secular tailwind that's going to be behind you. So I think oil does very well. We know the gas situation, where there should remain high demand for U.S. natural gas, and in a world where it's very difficult to find companies that actually have fundamental momentum, good balance sheets, dividends, capital return stories, and have very good secular tailwinds, it's very hard to find. And energy is something that I think will do very well. I would add on to that I think healthcare does well, and I think healthcare can do well just because it is less cyclical, has capital return in parts of the non-biotech market, and will be, I think, it'll be a place where people want to move dollars into as a way to be in a less cyclical group and also get some yield while they're there.
Speaking to this point of the zero COVID policy in China, we've had a couple of questions from the audience already surrounding the move that we've seen in the US dollar versus the Chinese yuan. I can add that it's fairly clear from the daily fixings being set by the People's Bank of China that they're trying to defend the yuan against weakening too fast right now. But is this yuan weakening on your radar in relation to the zero COVID story, Eric?
So it's on my radar. I would say that it is much less so on the radar of equity investors. Clearly the macro world is focused on it, but I would say equity investors are much less focused on it. And I think it should be. I think one of the things that that's going on really across so many different asset classes, that you're seeing these very large moves, whether it's the rate market, the FX market. Today gold was breaking down, and when you get these types of moves, whether it be in the 2-year yield, right, when you look at a chart of that and it has absolutely surged, these things typically happen. Typically something breaks, in whether it breaks in people's positioning, or it breaks a economy in the circumstance of rates, and it tells you that there's something going on under the cover that you should be concerned about, and that risk levels, I think right now, are at some of the most elevated levels that I've seen in a long time.
I can add that it's typically not a good signal when the yuan is weakening fast. It's probably the signal that Chinese capital is fleeing China. So quite the thing to worry about in my opinion. Eric, we have a couple of questions in relation to derivatives, because you're obviously also a derivatives expert.
Yes.
And we have a question from Bo in relation to the high volume of options. He's asking you whether this high volume of options is impeding price discovery and skewing prices, and whether the market has sort of turned into a derivative of the derivatives. What do you make of that tricky question?
So the options market has been used more and more over the last couple of years by the individual investor, and at times they've been able to move individual stocks based on very heavy option activity, typically with a duration of a day or a week. And they're able to, as a result, move many stocks. I think if we look at it on a broader perspective, and there is clearly an increased use of options. One of the things that we're looking at right now is that dealer gamma activity right now is, or gamma levels right now are very short, and that's one of the things that's causing the exacerbated intraday moves that we're seeing. So if you look at the S&P futures the last 48 hours, the intraday moves have been violent. And one of the big reasons for that is that the active managers are fairly quiet, but they're kind of watching, and it's really being dictated by gamma hedging that's going on from a very large short gamma position. I would also say that it's interesting, if you look at skew in the S&P 500, it's really quite flat, and I would say there's a little bit of complacency around the potential downside in the market, meaning that there's not as much demand for hedging for a large downside move in the S&P 500, which is one of the things that's keeping the skew fairly flat relative to the at the money or near the money.
Interesting observation. The final thing I wanted to debate with you, Eric, is whether you have any strong views in terms of sort of regional performance when it comes to geography. We obviously have a critical situation ongoing in Europe in relation to energy, but are you more or less concerned about European equity markets relative to the US equity market?
So it's a tough question, because I would say that I'm more concerned about the European economy. However, that's being reflected in the multiples that are being paid in Europe versus the US. So, to give you an example, we talked about the equity risk premium being at a 12-year low. If you look at the equity risk premium, for example, for Japan, that's at a 12-year high. So, their markets there's a big divergence going on between markets. The US market multiple is far greater than, rest of world, and that spread has been widening. So it makes it tough because I think we would, if we had a rank order where we want it to be, if we didn't know multiples, I think that would be a much easier exercise. And clearly, the European outlook, I think, is far worse than it is in the U.S. But when you actually do look at prices and multiples, it's a lot of that is being reflected, and that's what makes it tough. So, if you ask me right now, what trade would I put on Europe versus U.S., I wouldn't have a great answer because I think that's a very tough spread.
Yeah, I tend to agree, even though I'm being long U.S. equities versus European equities, but I am probably also pondering whether to close down that spread for now after quite a decent performance this year. But Eric, it was a great pleasure talking to you this afternoon again, and I wanted to sort of highlight your key takeaways for the equity risk premium in the US to return to sort of most palatable levels. In a historical context, we would probably need to see the SPX moving to the low 3000s. It is very tricky to say whether the European equity market will have an even more sour outlook than the US equity market, but the European economy is certainly in a bad spot. So it's not easy to say whether there is any place to hide on the globe from this list of negatives in relation to equities. And then the final point is that we should watch the positioning among individual investors, because that's essentially the shoe that needs to drop before the next leg lower in equities. Have I gotten this right, Eric?
Yes.
All good. Thank you so much for joining the
Andreas, thank you very much.
It was a pleasure hosting you, and thank you out there for watching the daily briefing again today. My colleague Maggie Lake will be back with more tomorrow, so see you there.